So perspective. The last administration in 2017 passed a tax bill, December of 2017. It was called the Tax Cut and Jobs Act. And it was designed to do that, to stimulate jobs and also to create some tax cuts. Well, it did exactly that. It cut tax rates, dropped the top marginal tax rate. And sorry that the print is so small on this, but this is what you'll be receiving. The top marginal rate dropped from 39.6 to 37%, which helped the higher income people, but it also dropped some of the marginal rates for lower bracketed people. The idea of brackets is something that's real important to understand. That's how our tax code works. And it's very helpful for you to be thinking about those brackets as you think about taking income or receiving income, because as you receive and take income, you push yourself into those different brackets. The other things that tax law did in 2017 is it increased the standard deduction. And today the standard deduction is, $21,000 or so. It's a little bit higher when you're over 65. You get a little additional break. And what that did is it eliminated lots of people itemizing their taxes in their tax return. So what it caused actually is many more people to use the standard deduction as opposed to itemizing. So there's some pros and some cons with that. It increased taxes on the wealthy, especially with the SALT deduction being pulled back so much. SALT is the acronym for state and local taxes. So it used to be pre that 17 Act that you could deduct your state income tax, your local property taxes, and people who are in high income tax states or who have lots of real estate property were able to deduct those taxes paid. Well, the Trump administration dropped that down to a $10,000 maximum. And no doubt that created some wailing from constituents. What's fascinating is that's being brought back for the benefit of primarily the wealthiest in our country. The reduction in corporate income tax also was rather substantial, dropping corporate taxes from 35% to 21%. So we had those tax cuts that occurred. Then in 2019, we had the Secure Act come along, and the Secure Act changed the required minimum distribution. It bumped that from age 70 and a half to age 72. And why the tax code would choose 70 and a half or 59 and a half, we're not quite sure where they come up with some of the rules, but regardless, the Secure Act bumped the RMDs up to age 72. So this year, you're required to begin taking distributions from IRAs if you're over age 72. Under age 72, you don't have to do that. The CARES Act came along and provided lots of lending that helped people through COVID and gave people a RMD holiday in 2020. So in March of 2020, after that point in time, people could defer or not take their RMD in the tax year 2020. The other thing that happened or is an interesting spin on this is qualified charitable distributions. So we'll talk a little bit about this a little bit later, but a qualified charitable distribution is a way to satisfy the required minimum distribution from an IRA, but give directly to a charity. So if you're charitably inclined, it's a very efficient way. In fact, it's probably the most efficient and the most effective way to make your charitable gifts directly from your IRA to those charities. Satisfies the required distribution. It does not pass through your tax return, which can change some other things like raising your taxable income, which raises your Medicare tax, something some people are introduced to this lady called Irma. So this does not count toward that. It's much more efficient to do your charitable gifting that way. So we'll talk about that later on here. One other thing the Secure Act did is it eliminated the ability to do a stretch IRA. So previously, if someone inherited, if a non-spouse, a child, for instance, inherited an IRA from someone, they were able to take the required distributions out throughout their lifetime. That now has been changed such that they're required to take the required distributions within a 10-year period. So someone can take some in the 3rd year or the 5th year or the 9th year, but an inherited IRA for the new law folks has to be fully withdrawn within the 10-year period. If you inherited an IRA prior to that CARES Act, well, you're under the old rules, so you're able to take it out over a full life expectancy. So a couple of those changes.